we are far ahead of many other markets, developed markets, in terms of data related to litigations and disputes. There is much more information publicly available. Our lifestyle of promoters often gets missed, and in this case, that was a fairly big red flag. But I think a lot of reliance is given very early on to whatever the founder is saying. Where are we seeing accidents? We are seeing accidents in company which are growing very fast, where a lot of focus post investment is on growth, on marketing, on efficiencies and profitability.
Do you think some conversations like that are happening? Or is it only relegated to burn rate? I hope the competition is not getting banked by SoftBank. I think there's so much focus on the growth metrics, performance metrics, rather than really about corporate governance and the overall resounding message that good governance is equal to a good company.
And we have seen old school fraud here, bank letters which are forged. Today, I can easily take a screenshot of basic information if it is available to an analyst or an associate and give it to someone. So leakage of information is actually beyond technology. The investment committees of those investors will suddenly use BluSmart an example and ask, how have you ensured this is not another BluSmart? That's a very generic question which will start coming. Like they will need to have their elevator pitch ready on why they are not another BluSmart, and that is beyond intent.
Hello and a very warm welcome to everyone. My discussion today is with a very special guest. I have with me Tarun Bhatia from Kroll. Tarun is not only an expert into the deep world of financial and risk advisory, a space where challenges are complex, stakes are high, and informed decisions make all the difference. I have known Tarun as a friend, as a well wisher, and an expert in the industry for about a decade now. Tarun, in this episode, we are joined by you, who brings on the board decades of experience guiding businesses through volatility, compliance hurdles, strategic transformation. And you not only help organizations manage risk, but also harness it as a driver of growth. The issue at hand today that we're going to talk about is definitely the unraveling of the BluSmart-Gensol fiasco. At one hand, there are two kinds of feelings that one is feeling through this entire unraveling. You get angry when you see what the Jaggi brothers did with Gensol. But at the same time, you also feel sad that for the first time, when our problems were being solved in the cab hailing space by a company which actually came forward to solve problems like timeliness, cleanliness, being sustainable to environment, is actually run to the ground because of the sheer greed of the founders. A similar case happened in the case of Byju's consumer facing company. The greed of the founder ran to the ground. Otherwise, a company which could have been so much more for the edtech industry at large. I want to begin this conversation by asking you, Tarun, what really is left of Gensol now?
Yeah, thanks, Shrija. So good to be here and talking to you. It's a theme which is close to me professionally, given the nature of work Kroll does, but also something over the last 25 years I've looked closely when it comes to governance. And it is, like you rightly said, disappointing that you continue to see such events, such fiascos, where not just investors, but customers and other stakeholders have to suffer because of acts of few. I think to a specific question, especially in case of Gensol, being a listed company, and I being a firm believer is market kind of is king. I think from a valuation perspective, whatever value the market is giving it, and I think it's down 85% from its price at the beginning of this event, is the value. Uh, I think looking at the nature of business, there is a complete loss of trust. There is very limited reliability on financial numbers. And hence, whatever value you see in market is really people taking a call on will it move from here or how lower can it go. But I don't think there is any institutional demand in this. And actually, which was one of the red flags. I mean, all of this is in retrospect for the larger community, but for a company which was with a market cap of 4,000 crore, had very little or no institutional interest in a very liquid Indian stock market. So I think whatever is left is bare bones. Uh, I think the brand was in any case the BluSmart-Gensol in itself wasn't a brand, so there is very limited value in that IP. I mean, I would not attribute too much left into the company at this stage.
Thanks for that, Tarun. That's a great segue to my other question, which you spoke about that Shrija, a company 4,000 crore market cap, but there's no institutional demand for such an otherwise liquid market that the markets that we have. So, Tarun, from your perspective, given you're a specialist in this, and I've known you for a while now, which large cases that you've handled and your firm has, you've expanded the team in the country right now. What red flags could have the forensic accounting could have spotted earlier in Gensol or BluSmart's financial behavior that might have averted this crisis? Were we all sleeping? Were the alarm bells not ringing in the right direction? What kind of missed us that this has now blown into a full blown crisis now, like really?
Yeah, no, so I think any event like this, Shrija, puts a lot of roles in question mark. And being a consultant, we are as good as our last work, and hence we have to be very conscious about the quality of work that you put. I think role of auditors, role of internal auditors, role of any compliance becomes very central into something like this. Now, of course, forensic as an activity comes in, when there's an accident. But most companies, especially listed companies, are expected to have the necessary checks and balances, in place as BAU, because a company is an independent person to that extent, and the balance sheet and the cash flows of the company are independent to the promoters. I think from what I have read, and I have no, as a disclaimer, not directly associated with any ongoing investigation into this company. I think the fact that such a sizable payment uh, were being made from company, this whole payout of 53 crores, the fact that there were ongoing related party transactions, uh, are initial red flags. Are all related party transactions wrong? Not at all. But just because somebody discloses it also doesn't make it right. I think one of the biggest challenge, or two biggest challenges I personally feel, which is plaguing, the Indian broader ecosystem is, still fairly opaque holding structures. It's very difficult to know who the ultimate beneficial owner in India is. And second is related party transaction. One in two fraud investigations that we do end up having an instance of related party transaction. The size and scale could vary. So I think in this case, given BluSmart, of course, has had some level of venture investments, the level of diligence which should go into in understanding its relationship with the parent would have been an important checkbox, which get missed in many diligences. People at times focus much more on the good part of the business. Lifestyle of promoters often gets missed, and in this case, that was a fairly big red flag as to where they are staying, the kind of asset they have purchased. And it's not to say that that's wrong. It's just to say, is it keeping pace with the way the company is moving. So I think those would be some of the red flags. I think now that there is a forensic accounting which is happening at a BluSmart level and all, it gets into the nitty-gritties. But I think at a big picture level also, there is a lot more checks and balances that can be in place, which clearly in this case were flouted. And unfortunately, the entire industry gets colored, with the same paint.
Thanks for that, Tarun. I mean, just sort of coming to the BluSmart issues, like you said that they were VCs. So the VCs must have done their diligence, and they do two kind of diligence. One is the financial, other is the legal diligence, right? So how could something like this must have missed the transactions with related parties, the Gensol affiliate, where were the fleet of cards coming in? Because one understands from the SEBI order that it was a multi-layered transaction. It was not naivety, it was actually a conspiracy that we have to basically surpass the eyes and the vigilance of SEBI. And the words that SEBI has used is basically very harsh. The complete breakdown of corporate governance is what they've used.
Yeah, so see, I think, I mean, I generally have a fairly high respect for the overall Indian VC community and VC segment. But what's happening is as the private equity slash VC investment culture has grown in India, and now I think it's almost 2 decades on, the ticket sizes for VC investments have gone up, but the diligence mindset has still not changed at a VC level. So we see a lot of early stage transactions where, founders, promoters get introduced. It's an innovative idea. So a lot of focus goes into the idea behind it and some degree of checks on the people behind it. But if the idea is very exciting, it's inversely proportional then to check you do on the founders. Whereas in a more mature growth stage company, the checks are much deeper. I mean, I need to pinch myself here because we have seen enough accidents, and you talked about byju's even in growth companies. So it's grass is always greener on the other side. But I think a lot of reliance is given very early on to whatever the founder is saying, because any financial diligence in an early stage company is nothing but stretching Excel rows and columns. It's basically your conviction on the people, and yes, this idea have takers in the market. BluSmart clearly had the right positioning at that point. So I think
So
the
the
take
lesson,
up.
yeah. So the
Sorry.
lesson to the VCs that you have to go beyond that product, technical capabilities, the promoter, the founder. But isn't that what the VC model is? I mean, they all sort of brandish themselves as founders first, but that does not sort of shield themselves from doing the diligence which is required.
No, it does not. And see, founder first, I mean, the other model in a very early stage is also a portfolio concept, right? So you take bet on 20 ideas and really one needs to succeed. Your all 20 won't succeed. Now you would want, I mean, you would hope that the ones that didn't succeed were business plans which failed and not governance issues. I think the double whammy here is the one idea which succeeded in that portfolio had significant governance issues. And I think that brings me to the other point is that there are different types of diligence and checks, and many of them can be done in-house. It's not, pitched to use a third party here. But as your portfolio company scales and grows, what are you doing differently to ensure your governance risks are now, monitored in sync with that scale? Because typically, where are we seeing accidents? We are seeing accidents in company which are growing very fast, where a lot of focus post investment is on growth, on marketing, on efficiencies and profitability, with a broader view that governance is important. So you'll bring in a more reputed auditor, you'll initiate an internal audit concept, but there is very limited effort to ensure that the overall governance framework, the people's mindset is also of running a company which is no longer a startup. Because when you're a startup, you're not, you don't have your SAPs and you don't have your detailed code of conduct and so on. But when you achieve a scale, you need to take a pause and bring that up to speed. Our experiences, companies keep growing and governance is barely catching up. And putting in independent directors is not a solution or, an equation which gets fixed by I have put two independent directors. That's not enough.
That's a great statement that while the companies are growing, perhaps the governance standards are not keeping pace with that. So, what really is the solution, Tarun? For instance, take an example of a company like Zepto, for instance. I mean, tremendous growth. And there's several companies like that. And the founders could be, albeit much younger, So one could presume that there is some bit of naivety on that part. But how do you prepare the company structures, the company board, that whilst we take care of the technical capabilities, but the investor is also working with the company to have a very strong board governance structures in place? Do you think some conversations like that are happening? Or is it only relegated to burn rate? I hope the competition is not getting banked by SoftBank. I think there's so much focus on the growth metrics, performance metrics, rather than really about corporate governance and the overall resounding message that good governance is equal to a good company.
Yeah, so I mean, not to single out any company out here, but what our experience has been uh, is that you're right. A lot of language does focus around growth, and the next round of capital exits and so on. But that's the reality of that industry. I mean, any investment industry works on an exit philosophy. That's how you lubricate the industry. So nothing against that. I think the challenges that we see are that lot of discussion in boardroom, even in listed companies, Shrija, not to blame just the private companies, is a lot on financial metrics, growth. Uh, 80% of the time just goes on, the first 2 points of the agenda. And then very little time is left for really asking the difficult questions. All the difficult questions are left to why did your margin shrink by X basis point? Why did the cost move up? But not on why has your CHRO exited. This is the third exit of a CHRO in last 12 months. A human resource leadership exit should raise as many questions as a CFO's exit, but it doesn't. A CFO's exit gets questioned because, are there concerns on financials? But there could be bigger concerns. Culturally, it is acceptable to, take an easy way out or shortcut. Similarly, we see a lot of companies making tech investment. Cyber security is this other word that, we have very strong cyber security. But very few companies or even in diligences do investors test the strength of cyber security. Today, so many B2C companies, even BluSmart B2C company, in the sense you have customer data and so on of your, people who hail your rides. How strong are your mechanisms to protect any leakage of information? Because the reality is there are hackers who are trying to get into your systems every second. So having a cyber breach is not an extraordinary event today. Your response to a breach, very few companies have any planning around that. So, we what we are seeing is we talk a lot about buzzwords, but there is very little focus on implementation, monitoring of how good or strong are those frameworks. And the same thing applies for, corporate governance. We are seeing more companies talk about whistleblowing because SEBI has been encouraging whistleblowing. But what happens to every 100 complaints that come? What do you do? Companies have no plan around that.
Thanks for that, Tarun. And I think some very, very important points that you have brought to the light. I want to also understand, for instance, the Baiju unraveling happened or the BluSmart unraveling happened, and both these companies are VC funded. So, what really are the lessons here for the VC investor? I understand that one can say that India is primarily a very minority investing market. You are always at the behest of the promoter. But are we really saying that VCs had no role to play? They also have to come up and accept the mistakes or the lapses that they had in terms of their decision making. Do you think that just putting the entire blame on promoters is right on the part of the investors who actually claim otherwise in the marketing statement or the press interviews to people like us is that we work closely with the company to bring them from point A to point B? So the responsibility has to be for the both the good part and the bad part.
Yes and no. I mean, see, I think what you don't want is investors to start running your company, right? The investors are taking a bet on the business idea and the people. If investors start asking question on every commercial decision that a company is taking, then it's not efficient. So I don't want to be too harsh on investors on the part of, what were they doing? Why were they not aware of each of these activities? That's not their job. And investors, especially VC investors, I mean, they are investing in so many companies. You can't have the same level of scrutiny. I think in this example and some of the other names that you have given, the size had increased materially, which is where I go back to your business scale has changed, but your thinking around governance is still as it's a small startup. Like the last role to be filled up in any KMP is the chief compliance officer. In many of these growing companies, I mean, if one were to do any empirical data, that's very evident. I think recently there was a report by Prime Database also on exits of directors. We have done many diligences where we highlight to potential investors that the auditor is changing every day, every year, sorry. Now that is public information. At times we are surprised that why was that not looked into even at the first level of screening by the investor themselves, because this is not a rocket science information. To me, that's not even a diligence question. The diligence question would be, why is the auditor changing every year? But the fact that an auditor changes every year was also news to an investor. So that raises question mark on, are you even looking at factual information in front of you? Which is why I said, like, the disclosure around related party transaction has improved because there is much more onus on that. But are you then questioning why these are happening? Where is the money going? What is the ownership structure? You know, we don't see that level of scrutiny happening. Or I think in this case, it was a very visible promoter group. There was a lot of communication on social media and so on. There are ways to validate, our claims that are being made in sync with reality. And the third thing, at least having been fortunately associated with companies who, have strong brand, is in many boards, and we go back to board, are you speaking to people other than the two founders? And sometimes just that access or that effort to speak to the chief business or the chief marketing guy will give you an insight. See, somebody who has to defraud you will defraud. I mean, you can't change that. But how are you diversifying your information access is equally important. So we feel some of those efforts haven't really changed. We have put limitations about number of board seats somebody could happen, and that's important because there were people who used to be on 20-25 boards. But we haven't culturally changed the way a board functions.
Some very valuable points here, especially in messaging to VCs and investors as to how should they look at their governance structures. I want to understand from you, Tarun, as somebody who has spent so much time in advising companies and really putting strong boards together on governance and sort of all of that. Where do we go from here in terms of the diligence levels of global institutional investors, raising money, future capital? This definitely is not the first or the last unraveling of a scam in the startup ecosystem, so to speak about. But does this have material implication on the fundraising or diligence level exercised by the incoming investors to India?
Oh, absolutely. I mean, I think any event like this, I mean, scale does matter, takes us many steps behind. I mean, I would say that at a level of information, that is today available on MCA, we are far ahead of many other markets, developed markets, in terms of data related to litigations and disputes. There is much more information publicly available. It's not available in a user-friendly manner, but it's available. So I think the country has taken multiple steps to ensure that the quality of information disclosure levels are better. I think events like this kind of take us backwards because it further creates mistrust. You suddenly start, like in this case, looking at all EV or EV financing companies, as suspicious. Because what really, from my lens, has happened is not an industry specific event. It's unfortunate that it's happened to EV or EV financing. It has happened to many other sectors, but definitely the next round of entrepreneurs, especially in this sectors, will go through significant scrutiny, more than their share of it, which is natural. I think the sector will at least temporarily see some slowdown in access to funding, both formal equity, but even for any leverage or lending, because PFC, IID, and others, and we have seen old school fraud here. Bank letters which are forged have been shown. So suddenly, that entire industry comes under some level of scanner. So definitely some impact. I think there's a lot of dry powder in India, and there is huge investment potential. But any event like this, and unfortunately, we are seeing multiple events come into the market within a short period of time, it definitely raises question mark over, the PEVC community as well.
Thanks for that, Tarun. I also want to understand from you, you alluded to this point about cybersecurity. So, how important is cybersecurity and auditing the trail integrity and assuring regulators and lenders operational transparency? How often should we engage ourselves in some of these exercises?
Yeah, so see, I think one of the stumbling blocks in our diligences that we have done, or when we have done investigations in not just B2C, even B2B businesses, because you're dealing with IP and so on, is like, people feeling that their job is to spend money on cybersecurity. So it's like, I keep joking, it's like people keep spending on heavier doors and fatter locks, but then they don't close the door. It's it's similar to that. So you're investing a lot, like the tech spend on security, if you take data for listed companies or private companies, has gone up. But we have done instances where everybody in the company has access to all the data. So leakage of information doesn't happen only through this. Today, I can easily take a screenshot of, basic information if it is available to an analyst or an associate, and give it to someone. So leakage of information is actually beyond technology. I think the other thing in cybersecurity is somehow we have still not migrated, and DPDD will change a lot of that on when you're dealing with customer data, especially privacy data. You have to hold it very close. But very few companies have an incident response mechanism. So you are investing in ensuring a breach doesn't happen, but when a breach happens, nobody knows. So that's a crisis management situation. Very few companies have a plan around it. I genuinely feel B2C companies need to have it. I think our insurance culture around cyber is just about coming in. That's very important. Like if you look at the West, if you have a cyber breach, you are told to first call the insurance. I mean, told to first call a company like Kroll or someone else who would start looking at a breach response and then go to an insurance company. But insurance companies have contact details of, all the firms like us. So I think there are things to learn from the West on the cyber security maturity. I think insurance is very critical. But I think the new companies law also require one of the board members should have, the cyber security kind of capability. It's one of the risk area. But we don't see too many board notes where this is getting discussed. So I go back to my old point. A lot of discussion in board is around business plan, next quarter, next fundraising, and not on key risks to business.
Thanks for that, Tarun. It almost appears to me that a lot of investors, the stakeholders in the investment fraternity talk about governance and these big words in conferences and media interviews. But sort of when it comes down to execution of the realities of it, I think we are sort of kind of pretty far. And what you mentioned that while the companies are growing, the governance is actually difficult to sort of catch up. There's a slugfest between as much as the companies are growing, but they're not being able to keep up with the compliance or the so-called governance practices. I have to also understand from you that now a financial advisory firm is being brought in. What are the immediate steps, if I were to ask you, should a financial advisory firm take is brought in to support litigation or asset recovery in a cross-party, multi-stakeholder case like this?
See, my personal view, at the sake of it being questioned, is introducing more intermediaries does not solve problems, Srija. If anything, it kind of creates more barriers eventually. Uh, I I think today there is greater accountability generally on third parties like auditors, the Section 143A, where they have to disclose any wrongdoing that they identify. NFRA has very strong teeth. I think the broader accountability of running the business transparently, genuinely, has to be on the stakeholders, the company management, the board. uh, I think a financial advisor can come and talk about better practices, step in if there's a wrongdoing. But if you look back at IBC, the whole introduction of IBC was again to kind of create more liquidity in distress assets, but also create a better culture around that. I think what we are seeing is there is definitely a better market for distressed debt today, but that's outside of IBC. IBC in itself, apart from the Dirty Dozen and all, there, I mean, we have to go and look back how successful has that whole model been. So I personally am not sure an introduction of a financial advisor is the solution. In some cases, it will help. But I think the challenge in our ecosystem would be a lot of these problems you refer to by Jews or others. I mean, once they get into litigation, it's a long winding road. I think if we want to create better confidence in the Indian ecosystem, put investors but also board and management under greater accountability, some of these legal actions would need to move fast. Like, I'll give you a very simple example. There is better disclosure, like I said, of financial numbers on MCA and on exchanges and so on. But if somebody who's not disclosing it on time, it's a basic financial penalty and so on. So, what are the implications of not achieving basic governance threshold need to become stronger.
The implications need to be higher. In fact, we had Sriram Subramaniam, who think govern research, and Romit Day of AP Partners, and both of them sort of agreed to that unanimously. What came out of the conversation was that this is criminal. I mean, whatever happened, and the IPC should be sort of invoked in this case. That's what sort of they were concluding to, because the ramifications are so much higher in terms of trust, in terms of customers, trust completely eroding from so-called VC funded companies, ramifications, the sector that you spoke about. When the Baiju's unraveling happened, for instance, it actually lent a bad name to the entire edtech space, which is finding it so difficult to reel from the woes even now. So my question to you really is that how can businesses protect themselves when one party in their operational ecosystem is under investigation or loses creditworthiness?
Yeah, I mean, that's a tough one. See, I think it comes down to your reliance on that party. I mean, in this case, that's the BluSmart case that we are referring. One listed company and the other private company, which is PE backed, but at the end of the day, common ownership, common control, I think very difficult. Also, I think businesses which run on brand, very difficult to recover. I mean, I think Jet Airways is a good example. I mean, different financial difficulty, but difficult to, revive a brand because people kind of make that new association. And then some of it hits the entire sector, as you said, what happened in, edtech industry. The general trust and faith and confidence in an edtech has gone down. So today, if a good company comes to you and sells you edtech, you'll first kind of think, is it fudgy? Is it not a genuine? Is there a scheme behind this? So I think that takes a long time. So I think uh, my view is the biggest way to de-risk in these things is old school, over dependence on one vendor, one customer means you're always going to be vulnerable to any event that happens to them. So, in a growing business, how can you reduce that dependence is very critical. I think a greater involvement of investor community in building out the senior management. We see that happening in large deals, in buyout deals where they bring in their own CFO, they bring in their own operating partners. I don't think it has to happen in all VC and startups, but again, as it gains scale, how are you professionalizing that ecosystem? And third thing, at least I see the quality of MIS that is available to investors. uh, I think there's a huge scope of improvement. I think it's a leverage game. I think promoters who are in a stronger seat start sharing less and less information. We have seen instances where they do not give full access to investors, where they do not allow their data to be audited, not the financial data, customer data or any key metrics. And I think it's a leverage game, like I said, because if they are in a position of strength, then they exert that strength of investors. Investors, unfortunately, also do the same. We also see the quality of MIS between majority shareholder or significant minority and other minority shareholders. There's a gap. So I think some of those things within the investor community also needs to standardize and improve. You should not differentiate between somebody who owns a 5% stake to somebody who owns a 25% stake in access to the basic information. That difference comes in board seat, shareholder clauses, and so on. So I think that's where I feel the investment community can also evolve.
Some very, very valuable points here. And Tarun, I would also like to understand from you that the promoter mindset in this country, I mean, this entire thing that I'm the owner, this company is mine, often promoters don't even listen to their own investors, right? Because the company is going so well. There's certain kind of arrogance, which is also celebrated in media, right? That okay, this company is doing so well. There's kind of smugness that comes with it, right? So if the promoter is not even listening to its own investors, think about the independent directors. I mean, in the case of the Gensol BluSmart fiasco, one observation was made that the independent director was trying to reach the promoter for about 6 months. Even then and there, he should have resigned, he or she should have resigned. So, what really remains of an independent director board? Are they just there for the heck of being there and rubber stamping the decisions of the promoters? Because almost looks like that.
Yeah, so the reality, Srija, today is it's very difficult to find an independent director. I think the number of independent directors in the market is coming down because multiple factors, the potential liability, the potential scrutiny you may go through if there was an event that happened today with ED, CBI, others, rightly so, because they are doing their respective jobs. And then, uh, how much of an authority do you really have in a board in such companies? So I think independent directors have a role, but I don't think we can rely purely on them because they're compromised in the sense their role is compromised. And the level of authority, like I have seen certain independent directors who have been able to enforce their authority, but that's a personality thing. I think just because you're an independent director, you are not given these kind of leverages. So I think it's high time we investors or others stop taking refuge behind independent directors. I think they are trying to fend themselves only at, at this point of time. I think each of the stakeholders has a responsibility in something like this. It's, like the example you gave, the independent director was not able to reach out. Maybe the resigning would have sent a message at least for others to question that. So yes, that's a valid question. I would say the same thing. Today the role of independent auditors are getting questioned a lot because auditors come in at a much later stage. So, has it migrated from a checklist approach to really asking difficult questions? I think my own thesis around this is how you run, your home or how you raise a family. You have to ask, sometimes you have to ask difficult questions. I think we are not asking enough difficult questions. You ask difficult question to your kids when you suspect they've done something wrong. You have to do that with your portfolio companies. And we have seen, a lot of promoters, the moment they see somebody's watching, they are okay. I mean, I think just because there was an avenue for them to take money out or put certain personal expenses on the company, they were doing it. The moment they realize this is not acceptable or this is being watched, they stop it. So lot of these frauds and governance lapses can be controlled just by asking basic difficult questions. It's by not asking them, letting the ecosystem feel that chalta hai, then 1,000 rupees becoming a crore and a crore becoming 53 crores, then you can't put in those systems in place. So I think asking some of those questions very early on is important. And we see some investors do it.
This chalta hai attitude has to stop basically, and what is small right now can magnify itself into something large. So Tarun, what should be the ideal communication frequency or set of questions between an investor and an investee company? What do you think? What should that really be?
So see, I don't think there's any golden rule. I mean, I think there are quarterly board meetings. I think there are monthly touch points with respect to information sharing. I think what needs to happen is, as that information comes to you, how much of scrutiny is it going? Are your associates just looking at it and confirming the data has come? Is it matching with whatever projection was given, or are you looking at it with a bit more analytical insight? Then going back to, are you asking the tough questions in your quarterly meetings? How closely are you monitoring exits? I think what gets monitored is percentage churn. Are you having 10% of your developers leaving in a tech company, or 20% of your the sales agent in a net tech company? The why of it is not being asked. I think, so looking a bit more closely at exits, at least in our experience, the ones who do it tend to catch, some of this buzz much, much early on. Some clients, depending on, young promoters or promoters who are a bit more vocal, social media monitoring, just being aware of, how much noise is being created around your investee company by the promoters themselves versus it being external voice and so on, is equally important. So I wouldn't say there is one answer for all, but I think you have to pick and choose what works for you for that company.
Thanks for that, Tarun. And I have to sort of also ask you, we spoke about the promoter-investor relationship, the ideal promoter communication with the independent board. Somebody once actually told me, an investor, that Shrija, you can have a lot of checks and balances in place. But if the promoter, he or she has made their mind, you can't deal with somebody's conscience. If you have made up your mind to cheat me, you will cheat me. So that is there. So if you want to do like a last dispatch to a promoter, you have made a mistake. You have done this corporate governance scam. Can you declare yourself bankrupt in a country like ours? Like I remember, for instance, this entire communique when the Satyam founder wrote that letter. And I recall an experience watching on the business channel, and they said that, I mean, the screen has to be blacked out because the anchors could not really assimilate and understand and could actually absorb that what he had written. He said that it was almost like riding on a tiger and did not really know that what I was doing. So when suppose some of these misdoings and happenings happen, what remains of the promoter to do at the end of it? Like what is the end game then? Like really?
So, I mean, I think I would have very, very little sympathy, if at all, with promoters who have consciously and genuinely defrauded. See, I think culturally, if somebody is out there to defraud or make a quick buck, you cannot stop that. I think what we are talking about is how soon can you catch it, how early can you detect it, and then your actions after that. I think all three are currently under scrutiny. So how soon can you catch it is a part of your monitoring. Uh, I work a lot with VCP, institutional community. I see a diverse set of monitoring. I come across certain people who are really top of their game. They do not hesitate, like I said, in asking the founders and promoters difficult questions. There is a way to ask them and all. I have sat on in board meetings as an observer, and I've seen good meetings and I've seen not so good meetings. So I think monitoring, and you set the bar for yourself. I think that's very, very critical. And I still believe, if it's like, if you're on the road and you see a police vehicle, by default, your own, behavior on the road changes. Even if you are not doing anything wrong, you are more alert. You just want founders to be more alert. So if they feel they are under some check, and that is not an unwanted check, I honestly feel this governance culture will improve. I don't think that scrutiny is there. Uh, I think the second is, if you find something is wrong, the investor community will always be in dilemma because they have to also protect valuations. So, at what point do you take a call that this is not acceptable, irrespective of the damage it does to the investment? Because you could find a fraud in the first year of investment, which is very different than finding it in fourth year, where, the numbers on cap table are very different. I think at that point, taking a band-aid approach and, saying, if it's a fraud, it's a fraud. I can't. I mean, it's easy for me to say I don't have my money where the mouth is. But we have seen investors who just take a call. This is not acceptable in our principles. We have to disclose. We have to take action. So I think uh, managing that dilemma is very important. And third is, I think you need to feel that the ecosystem will support you. So strong legal action, whether it's criminal action or, barring people from business activity, trading activities, capital markets, other aspects, is very important.
My last question to you, Tarun, really is that when some of these things that happen that unravel, what really are the implications on the broader ecosystem? Like you mentioned that Shrija, this can't really just go down as a governance case, governance failure in isolation. This will definitely have an impact on the sector per se, the institutional investors, how they are looking at diligence. But from a broader ecosystem risk, I mean, what really do you think will happen from this?
So see, yeah, there is a short and a medium term impact. I think the short term impact is, there is more question that founders, promoters in early stage companies, and especially in the sector, will face, because the investment committees of those investors will suddenly use BluSmart an example and ask, how have you ensured this is not another BluSmart? That's a very generic question which will start coming. So I think uh, that breed of entrepreneurs who are coming today will need to have an answer. Like, they will need to have their elevator pitch ready on why they are not another BluSmart, and that is beyond intent. I think secondly, it does dampen the broader, lens in which India's corporate governance is looked at. I think we are still not seen as a very well-governed ecosystem by global institutional investors. Do fraud happens in more developed markets? Of course, fraud happens everywhere. Fraud happens in US, Australia, Japan, UK. It's not that India is the only one which is seeing that. It's the frequency of it, uh, and the action post event, where I think the confidence level is currently low. So we've taken a lot of steps which has brought us forward, but every BluSmart will take us, um, multiple steps behind. I think some of the things that we are seeing positive in the investor community also is greater independence of compliance and legal functions in uh, funds. I work with funds where the GC of the fund and the CFO have the same say and the vote on the table as the investment partner. I wouldn't say that's true for all investors. So I think that also is a positive culture in that investor community, right? The moment the investor operates like that, their portfolio companies also take cues like that. So definitely, we are seeing, and that's not so much of protecting the downside. It is culturally, that's how they believe. I think if you see more of that, that will also reflect into the investee ecosystem.
Thanks for that, Tarun. And I think this conversation had some incredible, very meaningful, and very thoughtful lessons for the ecosystem, especially the investor fraternity. Because ultimately, you're bringing your capital to work, you're bringing your brand name to work. And for any VC or a PE fund, the portfolio companies are the flags that are basically rising high and talk so much about your investment acumen, your diligence processes in place, and what is it that you really bring to the table. So I think this entire relationship between the investor and the investing company, keeping in mind corporate governance structure, diligence is extremely, extremely important. And perhaps engaging with firms like yours becomes critical important, not necessarily as a pitch that I'm doing, but just generally to keep the ball rolling in the right direction. What do you think?
Yeah, I mean, I think governance is an ongoing thing. It's not a one-time thing. I also genuinely believe that a lot of investors can do first level scrutiny diligence on their own. They don't need a third party for it. Someone like Kroll should come in specific situations or specific aspects. I very much believe it's a culture thing. It's what we kind of talk about in our own organization, as you're growing, as you have new people, as you have young chartered accountants, fresh, MBAs or graduates coming in. It's the language that you speak in your ecosystem, which makes a big difference. I think that's where investors, uh, need to grow a bit more.
Thanks for that, Tarun. Thank you so much for that meaningful conversation and spending your time and energy with us. Until the time I see you next, goodbye and good luck.
My
Thanks.
pleasure. Thank you so much, Srija.
Thanks, Tarun. Take care. Bye bye.
Bye.